One of the biggest challenges to people getting into the property market is the size of their deposit relative to their loans and the need for them to go out and get lender's mortgage insurance. Today, I want to talk about the implications of that and where I think some government and business innovation needs to be targeted at. So as we go through and have a look at where the property market is, we've had strong prices in capital cities over the past 12 months. And now medium values are really starting to get up there. The reason for this, let's have a look at Sydney, for example. And the reason for this is because there has been a huge undersupply. And normally what I talk about in my weekly updates is macro factors. I have a look at the macro factors that are driving interest rates. And as we all know, interest rates dictate where prices go. And so today I want to do something a little bit different. I want to point to some of the challenges in the market, because a lot of people that watch these videos and a lot of people that read this analysis are looking at getting into the market, either to portfolio or to buy a place to live in for themselves. And if you have a look at the Sydney market, for example, and we go back since COVID, you can see that the market had a really, really big run. And even though we've come down, we've recovered from our losses and the market continued to grow last year. So the market grew by 11% in Sydney, even though in January the rate of growth was at 0.2%, but the market is still heading upward. It's still in a rising environment. And when interest rates do get cut, and they will get cut, when interest rates do get cut, I believe towards the end of this year, could be early next year, but I'm still holding my view between June to September, and the data seems to be reaffirming that. When that happens, that's going to push the market even higher. And in the absence of supply, it's very hard to see, prices coming down. Now, the challenge is this: as the market continues to rise by more than people's incomes and more than people's savings, very important. It's not just income growth, but savings growth. The amount of people that are priced out of the market because their deposit is not large enough continues to grow. And this is where I believe there will be some policy targeting. The federal government has come out with the first home buyers guarantee scheme. And basically what that does is it allows buyers to go out and use a 5% deposit and get a 95% loan backed by the government without having to pay lender's mortgage insurance. Now, the problem with that scheme is the caps around, not so much around income or eligibility, but around what you can buy is limiting in more and more. So about $900,000 cap, you're very limited in what you can buy in a market like Sydney, or even if you have a look at the other markets, Melbourne, Brisbane and Adelaide continue to go up. The market is trekking higher and higher. And what happens is the median prices of homes in these markets continues to go up. So these government schemes need to ensure that the price caps are relevant, because people will be priced out of the metro or regional markets, and choice is going to be very limited. And so those schemes need to be relevant. And so I think for me, that is a big issue where not just government grants need to be targeted, but also innovation in the lending space in terms of offering more and more products particularly to those who can afford them, those who have the means and the capacity, but are finding it difficult to get in on your average 25, 30-year mortgage under 20% without having to pay lender's mortgage insurance. That lender's mortgage insurance really does eat into the deposit. And then what happens is that you're priced out of the market even more, because your $100,000 or $200,000 or even $250,000 deposit in Sydney today, when you have, home prices 1.5, 1.6 median prices, you're really, really priced out. It's very hard to get a 20% deposit, which is $300,000 plus your stamp duty in a market like Sydney. That's going to happen in Melbourne. It's going to happen in Brisbane. It's going to trickle and flow through. So I think that deposit issue is something that I'm going to be watching very, very closely. In terms of where the market is, the latest chart pack from CoreLogic, as I'm showing you today, shows that gains have perhaps consolidated, but because of this tight supply picture, we're not having a real pullback in prices. And this was really interesting for me. For the end of January, this number would have no doubt been updated for February when the chart pack comes out. But Sydney is 2.4% below the record high in January in terms of the median price. So the dip that we had with rising interest rates has now been more than offset. And that's the beauty about the Sydney market, that when it does fall, the extent of the declines are nowhere near as big as the gains, as you can see on the gain chart, and that those gains are quickly made up. What I want to do in this video also, I'm not going to end it without talking macro. So what I want to do next is talk GDP and then wrap up with where I believe rates are going towards the end of the year. But I really wanted to make that important point around deposits and the need to innovate in that space. So the national accounts out this week basically point a picture of where the Australian economy is, where we are on the global stage, and what our growth profile looks like. And it ain't good news. GDP growth is very, very weak. The economy barely grew in the last quarter, up 0.2% in seasonally adjusted terms. And the real issue that we have here in Australia is what I've kind of been pointing to over the past month. The RBA has been slowing the consumer down too much, I believe too much, and they've put the brakes on too hard, and they're going to pay a price for that. We're starting to see that in the rise in unemployment. We're starting to see that in worse than expected retail sales numbers, and to me, that's going to get worse. The second part that I think we're missing is the impact of the commodities slowdown, which is very important to Australia's GDP profile, the composition of our GDP. And where I'm starting to see that is in business inventories. So these are very, very chunky numbers. GDP numbers are very chunky to read. I'm not going to go through them and bore you with them, but what I think is really important is to watch the trend. And what I'm seeing in these trend numbers is that businesses are starting to cut back on their inventories, pull back on their inventories, draw down on their inventories because they are seeing, feeling, tasting, touching a slowdown. And I think what happens in the absence of government and in the absence of a commodities rally and in a rising interest rate environment, I think what you start to see is that the Australian economy starts to suffocate. Over the next few quarters, I think there is a chance that we could have a negative growth quarter. And when we do, that R word is back on the table and the RBA flips. The situation on the RBA will flip. I still believe that happens March, April. We have a presidential election happening in the United States. And so the timing of this may not play out exactly to plan, but it's very hard for me to see where something comes out of the blue and saves the Australian economy with where rates are at and where the RBA rhetoric is at the moment. We get another RBA meeting in a couple of weeks. I'm going to be very interested to see if they stick to the bluff that they've been putting out into the market, that they're willing to increase rates. That bluff is going to be called out, and it's going to be a big about face for the RBA come mid-year, come third quarter, when the national accounts don't look good, the unemployment rate doesn't look good. Canberra is going to be sending out signals because there's an election coming next year and there's uncertainty in the world. There's uncertainty around commodity prices. Let's wait and see where that goes, but I wanted to touch on this. The trend is definitely starting to come down, and Australia's place on the global stage is starting to look shaky. Big factor driving that is the RBA.